thank you very much, Jeff, for the introduction. We're pleased to be, I guess this is my first time here with Prophecy Platinum, I think, for the CPM event. Last time I was here, I think I was with my silver company. So my name is Greg Johnson. I'm president and CEO of Prophecy Platinum. I think we have a pretty exciting story to share with you, and I think we'll have a presentation from the CPM group on the fundamentals for platinum. We'll touch on it just briefly, but I think fundamentally what I want to share with you is why we're, as a team, all quite excited about the development that's happening at our projects. So let's go ahead and dive in here. Forward-looking statements, I'd direct you to our annual information form to really take a look at the risks of an exploration development stage company. So what are the key components as industry insiders that we look at in terms of successful project development, and why are we excited about particularly our project in the Yukon? When we look at these key components, when you see all of these components in place, it really, in our mind, is what, as an investor, you want to try to focus on. Starting with size of the resource. Really, for the market to take notice, it's got to be big enough to matter. It's got to be something that the majors are going to be interested in. At 7 million ounces of platinum group metals in an open pitable configuration, this is a world-class asset. Anything more than 5 million ounces would be considered world-class. Production potential. This asset has the potential to be one of the largest producers in North America in terms of PGMs, comparable with Stillwater, who is the largest producer. The team, we all have experience in mining, 25, 30 plus years of experience, and particularly experience in the PGM sector with Xstrata, Vale, as well as experience in the Yukon in terms of building mines. Exploration potential, I'm an exploration geologist by background. This project has all the earmarks of a world-class system, and we think the opportunity to have additional discovery is really excellent, and we'll talk about that a bit more in the presentation. The Yukon is ranked one of the top jurisdictions for mining in the world. It's one of the best jurisdictions in Canada for mining. The government is very supportive of mining development. Mining is their business. It is their industry. Meeting with the government here, it's a very small population. They're very accessible. They want to know how they can help and how they can work with industry. And they've done a great job over the last several years of streamlining the permit process, allowing you to know what the hurdles are engineering-wise and to be able to meet those in a timely fashion. And then fundamentally at the bottom here, we think, as we'll see in some of the slides, the fundamentals for the PGM sector are probably the best in the precious metal space entirely, based on the fact that you've had structural problems, which are creating basically a constraint on supply, and we've seen falling supply for the last 5, 6, 7 years, particularly out of South Africa, and continually rising demand. So this really sets up the fundamentals for a situation we think could see significantly higher prices. The team here, we all joined about 6 months ago, last fall. Myself, my background, I started out with Placer Dome and Barrick, was a co-founder at Nova Gold, South American Silver, and this is my third public company with Prophecy Platinum. John Sagman, our Chief Operating Officer, also started out with Placer Dome. He worked for 20 years for Xstrata and Vale in the Sudbury District mining nickel PGM deposits, and then most recently with Capstone, where he was part of the construction team for their Minto project in the Yukon. Jeffrey Mason, our CFO, comes to us from the Hunter Dickinson Group, where he has been involved in a number of their projects over the years, and really is bringing a great financial stewardship to the team. We're building the exploration team, we're building the engineering team on the ground. You'll see some announcements in coming months on that front. But really a very strong technical team. Everyone are either geoscientists or engineers, and we believe in the owner-builder concept in terms of advancing projects. So let's take a look at how Wellgreen stacks up against other projects here in North America. This chart is showing production of the major producing PGM mines in North America. Blue is platinum ounces, the scale on the left. On the right in red is the palladium production, and this is scaled for relative value so you can get a sense. So Stillwater is really a palladium mine, but with the largest platinum production in North America. The Coleman mine for Vale in the Sudbury District is the second largest producer. And based on our engineering study from last year at Wellgreen, we're right in here at around number 3. On a platinum palladium basis, we produce about as many ounces in the projections for each metal, but at current prices, the palladium value is lower. So we have significant exposure to palladium. But I would point out that these are based on very conservative assumptions. Our initial metallurgical test work assumed less than 50% recovery of the platinum metals. Benchmarking it against other deposits of similar mineralogy, we would expect that number to be much higher. So if you start to apply more benchmark recovery numbers, we could become even more significant than what's shown here on the chart. If you take a look at the top producers in the platinum palladium space, and particularly if you compare this with gold, it's really quite striking how much smaller the sector is compared to the gold market. To be a top 10 producer, you probably have to produce 1 million ounces of gold a year. You are a top 10 producer in platinum and palladium at 150,000 ounces a year, which is roughly the production level we're looking at for Wellgreen. So it's a much smaller market. Even a small project is meaningful in this sector. And as you saw on that last chart, you can see the addresses of these things. Really, you have 3 regions that dominate production: South Africa, Russia, and Zimbabwe. So the opportunity for supply disruption is nearly guaranteed. And it's, as you'll see, when we talk about the structural issues in terms of their cost issues in the industry, we think that it's a very good market to be looking at a project here in Canada. If we take a look at our peers in North American or Australian, so first world located assets, you've got the 2 producers, Stillwater and North American Palladium, as producers. This is resource ounces in the ground. The 3 largest resources are Duluth Metals in Minnesota, ourselves in the Yukon, and Polymet in Minnesota. A couple of assets in Australia, and then another one in Ontario. This is almost the entire development stage peer set. So it is a real scarcity of quality assets out there to even be looked at in first world jurisdictions. And that's just a fundamental outlay of the geology. Platinum is a scarce metal. It's concentrated in just a few regions globally, and there just aren't that many deposits to be looked at. If we look at these same group of companies on a valuation basis, similar to what you might see in the gold space, the silver space, what you'll see is whether you're looking at an enterprise value per ounce or a price to NAV, the producers trade at a premium. Right now on an enterprise value, the producers are averaging about $125 an ounce on the ground. At feasibility stage, you see a discount to the value you'd be worth in production. Right now, those feasibility companies are trading at about $30 an ounce on the ground, reflecting the fact they still have to permit, construct, finance. So there's still risk and equity dilution. And at the early development stage where we are, the average is $3 an ounce. So you can see there is a notable increase in capital appreciation if you can take a quality asset from this first engineering stage into feasibility as you advance those assets and de-risk the project. And effectively, that's our business plan. Building the team to advance the asset to feasibility over the next couple of years, and then look at the best way to advance the asset into production. I'll talk just a couple of minutes on the fundamentals. Historically, platinum has traded at a premium to gold. Since the 2008 crash, it's basically been close to parity, though recently in the last 12 months, platinum has been outperforming gold on a relative basis. If you contrast gold with platinum and palladium, and this chart just kind of lays out some of the numbers, you can see how much smaller the total market is compared to gold. You can also see how much more significant the industrial component is for palladium and platinum relative to gold. And in fact, you can see here for palladium currently, if we didn't have recycling coming into the market, the industrial demand far exceeds what is actually mined each year. The other thing that's quite present when you take a look at this and notable is a change in supply. 13% decline in platinum production in 2012, 11% decline in production for palladium. And that's been an ongoing trend, as you'll see here in a few minutes. It's resulted in a deficit. We're currently in the platinum market, the deficit is equivalent to 10% of mining supply, and in the palladium market, it's equivalent to 17% of annual mining supply. So this bodes well for higher prices. One of the fundamental issues here is that production out of these deep, narrow seam mines in South Africa is quite expensive. And due to the rising cost of labor challenges with energy supplies and high cost structures, where 70% of your producers today have all-in costs that exceed the average price of platinum. We are not seeing the industry reinvest, and in fact, many of these mines, there have been announcements over the last year that they're going to be shutting down a number of these South African operations. This reminds me a few years ago when silver was trading at $5 an ounce, and it was a really crummy business for the mining companies. And you saw many of these operations shutting down because they just couldn't make money. And we subsequently saw the silver price, move up through the 20s, the 30s, even at one point hitting $50 an ounce. I think structurally we're seeing a similar situation. You can't continue to operate at these kind of levels if you're not replacing and making money on your operation. And we think these fundamentals bode well for higher prices for platinum and palladium going forward. The driver here for both metals is really catalytic converters, 33% of the market for platinum, 66% of the market for palladium. And you can see the growth is largely being driven by China and the developing world. And we think that trend is going to continue. If we take a look at the individual metals, again, highlighting year-on-year growth in demand since the early 80s, and since 2006, falling mine supply, pretty consistently falling. On palladium, same trend. You've got some spikes that occurred in the mid-90s, late 90s, but effectively you've seen a year-on-year growth of about averaging around 5% since 1982. And since 2004, we've effectively seen about a 3% decline per year in mining production. The recycling supply has come in, but over the last 3 years or so in both platinum and palladium, recycling has been relatively flat. So let's dive into our project and talk a bit about what we are doing here at Prophecy Platinum on the Wellgreen project. This is a photo of the project area. Historically, this area was discovered in the 1950s, looking at high-grade underground mining seams. It was discovered by Hudbay, one of our mid-sized Canadian miners. They put it into production in the 1970s as a narrow zone, high-grade underground operation. Because of falling metal prices in the 70s and difficult, narrow underground mining conditions, they shut the operation down. And the project was re-looked at by a number of other groups subsequently. The big breakthrough on this project that allowed it to be thought of as a bulk mineable situation was when one of our predecessor companies, Northern Platinum, came in and drilled a big hole underneath the historic underground mine and recognized for the first time that the entire package of ultramafic rocks was mineralized with disseminated platinum mineralization that was over zones that were hundreds of meters in width, suddenly allowing the team to recognize that this was something that had bulk mineable, open pitable potential. The project is located here in southwestern Yukon, just off the Alaska Highway. So it gives us excellent infrastructure for access in and out of the project, as well as for transport of our concentrates. We have 2 different ports here at Skagway and Haines that are on paved highway from the project. We would be shipping similar trucks to what Minto or Wolverine does currently to their ports, and a much shorter haul distance than either Wolverine or the Alexco mines to the north. In addition, right now there are a number of opportunities that are being looked at in the Yukon in terms of powering many of these development projects. The Yukon is probably one of the fastest growing exploration and development areas in Canada. As an emerging district, you've had 3 new mines built in the last couple of years, shown here in the blue. 4 projects are at feasibility, shown in red. Probably 50 exploration and development stage projects that are on the books and being looked at. And they're looking at the opportunity for liquefied natural gas as an energy source for many of these projects. And our project, fortunately, sits north of grid power here at Haines Junction that could allow us to bring a power line into the project. Looking a little bit closer to the project itself, here's the Alaska Highway. Here's our 15-kilometer access road that comes into the project site. This is 3 mountain ranges in from the coast, so it's quite low precipitation here. This is a semi-arid subarctic climate. We get very little snowfall. It allows us to operate year-round. You really don't get much better northern access for a project than this. So this is that same photo that we saw a few minutes ago, and it's highlighted on this is the mineralization. So the historic focus was on this dotted red line here, which would be the basal unit that had very high grade concentrated metals that were focus of the early mining activity. The yellow represents the disseminated zone of mineralization where it comes to surface and really illustrates the scale of this. In the next slide, I'm going to show you a slice through the mountain here to give you a sense of the scale of this, this deposit. Everything in this photo that's basically purple or orange are what we call ultramafic rocks, and they are the host of our ore body. This is one of the thicker parts of our deposit, but effectively from surface to 500 meters is continuous mineralization averaging about 2 grams per ton platinum equivalent. And at the lower end, this lower 250 meters is running close to 3 grams per ton platinum equivalent. These are comparable grades to what are mined in South Africa in zones that are between 0.5 meter and 2 meters wide at depths to 1,500 meters depth underground. So this is really what sets Wellgreen apart from any other project that's out there, is the scale of mineralization, continuous mineralization starting from surface, and its amenability to a project that can be open pit mined. If we compare some other factors between the South African projects where the bulk of production is, in addition to the mining widths, the grades here at Wellgreen, we see grades from about 1.5 grams per ton platinum equivalent up to 4.5 grams. That compares with average grades that are in the 3 to 4 gram range in South Africa. If we take a look at a grade thickness, many of these mines are operating in zones that when you do width times grade of the mineralization are in the 5 to 15 gram meter level. A very wide zone in South Africa would be 100 gram meters. We're looking at an average of about 100 gram meters for most of our mineralization and zones that are exceeding 1,000 gram meters. So that's the equivalent of 1,000 meters at a gram or 500 meters at 2 grams, which is really world-class in scale. In addition, because we're looking at open pit mining, our operating costs are substantially lower. We'd be looking at about a 0.5 gram platinum equivalent cutoff grade compared to a 2 to 3 gram cutoff grade when you're looking at deep seam underground mining in South Africa. The company's undertaken some metallurgical test work as part of our first engineering study that was released last year. This was really designed to determine whether we could recover our metals through a conventional flotation process and whether we could separate it into two products, a copper concentrate and a nickel concentrate. This next round of work that we're looking at is designed to benchmark our project against other projects in the industry with similar mineralogy, and we're expecting that we'll be able to have a significant increase using optimization of the recovery and flotation process to be able to bring our recoveries up significantly from what were used in the PEA. The main number I would point out here would be the platinum recovery numbers were under 50% based on very preliminary work. And we would expect to be able to bring those numbers up into the 60s, 70s, or even 80% with additional optimization work, which will be quite significant in terms of the economics and the level of production that we can achieve. The preliminary economic assessment used quite conservative metal prices. The SEC guideline for reserves is 3-year average metal prices. We've used 3-year average prices minus 20%, so to add a layer of conservatism. We've done that because on the 5-year price chart for nickel and copper in particular, you can see that gives you a pricing here that if you look at 2008 as an extreme event, it effectively is kind of a trough pricing level for those two metals. So adds that layer of conservatism in our assumptions. For the precious metals themselves, if you're looking at 1270 platinum, 465 palladium, and 1100 gold, is much lower than today's prices and it is, we think, an appropriate level of conservatism to use when looking at your economics. Plug that into our model, and what you get is still, at those conservative prices, a quite attractive project with just under $1 billion net present value at an 8% discount rate and generating about $200 million a year in cash flow. Now, that project also gives about a 37-year mine life, which does not maximize your project from a net present value point of view. At an 8% discount rate, really, there's no value after about 18 years. So if Rio Tinto or a large mining company was to build this project, they probably would build this at twice this throughput to bring the mine life down to under 20 years. But one of the opportunities that we're looking at, particularly in today's capital markets, which are concerned about access to capital, is we have significantly higher grade zones within the deposit. And so we're looking at the opportunity in this next round of exploration work to target higher grade zones that we could actually look at elevated cutoff grades and run at lower throughputs, lower capital intensity, higher rates of return, to be able to have a project that we can finance ourselves and advance, while at the same time balancing that with what's the global project look like. What would a major mining company want to see in a project, and balancing those two aspects. And we expect to be able, using that approach, to develop some scenarios that look at lower capital intensity, higher rates of return, and make this a very attractive, smaller project that our company could move forward with. One of the things I mentioned in the fundamentals on the metal section was the price pressure that's on many of these producers. And this chart, which was just released in the last few days by on the cost for the industry for 2012, really illustrate this. The red line represents 100% of the mining companies in platinum in terms of their direct total cash costs. This is the average price of the platinum for 2012, and the yellow line represents that all-in cash cost. So that's basically factoring in your direct cost to mine it, plus the cost to run the company, plus the sustaining capital. And you can see here that 70% of the mines in the platinum sector are not basically meeting their all-in cost of production, which is just not sustainable long-term. Because of the byproduct credits that we would see at Wellgreen in terms of nickel and copper, our project actually would be in the lower quartile, perhaps even in the lower 10th percentile due to those byproduct credits. On this chart, we're showing a co-product accounting, where we're basically allocating the cost of mining towards each of the metals proportionally. But effectively, if you credited your copper and your nickel against production, you'd have zero cash cost, where the nickel and the copper would pay for the mining. So it would be a very low-cost operation. So we've got an exciting project here in terms of scale, in terms of the resource, in terms of the exploration upside. I think this really has this project stand out on a number of these factors. I'd like to just take a second to talk a bit about the exploration upside as well, because this is one of the aspects of this project that's quite exciting, and I don't think it's well appreciated. This area in green here is the 7 million ounce resource that we currently have on the project. The stippled pattern represents the surface expression of where we have these ultramafic rocks that host our ore body that come to surface. The red diamonds represent areas where we have ore grades over widths of historic work. Last fall, we undertook a couple of surveys to be able to prioritize the target areas in the project in addition to our main resource area. And the two tools that we used, one was a magnetic survey. These ultramafic rocks have a high magnetic response, so you can use that as a mapping tool to determine where those are. And the second was surface geochemistry, so sampling the soils, which are weathered bedrock, as an indication of where you may find additional mineralization. Here's the 7 million ounce resource area. You can see in these hot colors this high magnetic response. You can see it continues for another 2 kilometers into this area that we call the Quill target. And we have a second area here at Burwash, which is aerially about 1.5 times larger than the main resource area. When we combine that with the surface geochemistry, we can see again the 7 million ounce resource area, and you can see how it lights up in the copper and the PGMs. You can see that it continues over into this area of the Quill, and you can see the very nice response that we received in the Burwash area. This is an exciting set of coincidental data points that tells us that exploration-wise, we have the opportunity for potential new discoveries of significant magnitude on the project. In addition, both ends of our project, the west and to the east, have high potential for discovery of higher grade zones, and that'll be one of the areas of focus for our project this year. Will be to look at those higher grade zones of mineralization to see if for the first 5 to 10 years of the mine plan, we can in fact find a significantly higher grade material, which could be the startup operation. So let's talk just about what are the key milestones that you could inspect as an investor over the next 6 to 12 months. Starting last fall, we kicked off a series of transportation and logistics studies to look at power, to look at access in and out of the project, and what the optimal approaches are. We established our environmental baseline collection stations. You need 2 years of environmental data in the Yukon to do the permitting. We have an ongoing consultation process with the First Nations, the Native people. They've signed an exploration cooperation agreement with us on the project, and in fact, they selected these lands for mining, so they're very much supportive of the project. We're looking at kicking off a drill program, an exploration program this summer season. that's going to target this higher grade zones, particularly on the west and east sides of the deposit. We have a focus on converting the inferred mineralization into measured and indicated, which becomes reserves when you have a feasibility study, as well as wanting to put a few holes into those priority exploration targets that we saw on the last slide. We've initiated a second follow-up round of metallurgical test work. So our samples are now at the lab to look at optimization of our recoveries. This could be very significant in terms of what it means for the economics on the project. And we're looking forward to see what we can do. And we're focusing on looking at this lower CapEx startup option that would allow us to look at a smaller capital intensity project. That would position us for a major update on the engineering and resource front first quarter of next year, and allow us to begin pre-feasibility work in 2014 and feasibility and permitting work in 2015. And in the Yukon, if we look at some of the recent examples for permitting projects such as Alexco, they've been able to permit those projects in under a year, which is quite fast for a North American project. And if you can work well with the agencies, we found that the Yukon is an excellent jurisdiction to work with that way in terms of facilitating and advancing your permitting process. So I want to take just a second to mention our second asset, the Shakespeare project, which is located in the Sudbury district in Ontario. This project is smaller than Wellgreen, but the reason it's significant is that this is potentially a near-term cash flow generator for the company. This was a mining operation between 2008 and 2012. It was shut down in early 2012 because of falling primarily nickel prices. We acquired the company, 100%, that owned this asset last year, and we are looking at cost reductions on this project. It's fully permitted. It's in care and maintenance currently, and we are looking at a potential to restart this project. Three key areas of cost reduction that we're looking at. The toll milling contract with Xstrata, we believe has significant room to be renegotiated, and in fact are in negotiations currently to work on that cost area. The transport cost for the project, we've got an alternative transport route that would go across First Nations land to the north and could be a significant cost reduction. And the third element is looking at just overall mine efficiency and mine planning. If we can achieve a 20 to 25% cost reduction, which we think is reasonable, this project is viable at today's metal prices, even though the nickel price in particular is quite depressed. And at about 20,000 ounces of platinum, palladium, and gold a year, 8 million pounds of nickel, and 10 million pounds of copper, this could produce significant cash flow for the company on the order of what we need to invest in the Wellgreen project over the next couple of years for engineering. So effectively, this may be an opportunity for the company to be self-funding over these next couple of years on the larger Wellgreen project and developing that. So over the next 2 to 3 months, we're going to be studying this to see where our cost estimates are coming in and look at the potential for a restart on this operation. We're effectively looking at a $1 to $2 million restart. It's just mobilizing the equipment and the contract miner in to begin mining again. And we really, through these studies, just want to revamp the mine plan, understand those cost reduction areas, and identify at what price point it makes sense to turn this project back on. So in conclusion, those of you who have been following the space have probably seen it's been a pretty tough market. Over the last 2.5 years, the market has been in a consolidation mode, reflecting consolidation in the metal prices themselves. Most of the metal sector equity prices peaked in December 2010, so we're now getting on to some 2.5 years of consolidation. This has taken us to some of the lowest levels on many of these equities that we've seen really since 2008, and in many cases since before 2004, 2005. Our company has not been an exception to that. This is the TSX Venture Index, this is the Junior Gold Miners Index, and this is our stock price. But with the new team coming on board in November, we've held up better on a relative basis than the other groups in the sector. If we take a look at a relative valuation point, this is the GDX, the Gold Miners Index, and the Platinum Miners Index. You can see the bottom here in 2001, this top near 2010, and you can see how extreme this fall has been in terms of valuations in the mining companies. On a relative basis, if you compare that with the metals themselves, what you'll see are these broad ranges in valuations. And this current level, when you look at metal prices versus the miners' valuations, is the lowest prices and relative valuation since 2008, 2001. And though we don't have as much history on the platinum miners index and the platinum price ratio because it's a newer ETF, you can see it's followed the same pattern, and we're likely at one of those once in a decade type valuation points where interesting companies are trading at 70+% lower than they were 2 years ago. So for investors who are looking at this sector and looking at quality names, this is one of those valuation points in the sector where you're not buying near a top, and in fact you may be buying at one of those rare points that come along infrequently, where high quality names are at exceptional values. And I think this is a time to be looking at investing in quality names in the sector, looking at exposure, and particularly in the PGM sector, where I think the fundamentals themselves for the metals appear much more promising in the near to longer term basis. And with that, I think if we have a bit of time, we can turn it over to some questions. Yes, sir. You know, we're kind of looking at the capex on the PEA here, which was the 30,000 ton per day operation, which is a relatively large precious metals mine, was just under $1 billion. So we're looking at something that would maybe be 15 to 20,000 tons a day, maybe even smaller. We're looking at what the level of the higher grade blocks are in terms of tonnage, but we're kind of looking at something that might be in the 200 to 400 million range, which if you're a company of that market cap, which we've been in the past, following the release of our resource, that's manageable. That's the size of a project that the market is quite interested in, particularly if you've got robust rates of return and you're able to look at something that can be scaled up over time. So that's kind of the target range that we're looking at on that. Yes, sir. Yeah, we're looking at that. The previous operators had a cost that right now would not, if we were running it at the same cost structure as the previous operators, it would not be viable at a $7 nickel, 325 copper market. Particularly the toll mining milling contract with Xstrata is not market. It's quite onerous terms compared to our knowledge of what they charge their own mines. So they are open to negotiations with the companies who are currently engaging with Xstrata. Secondly, the First Nations who are involved in the project have approached us about the potential to transport the ores across their lands, which would be a significant reduction in our haul distance to the toll mill for Xstrata. It could be as much as a 30–40% reduction in our transport costs. So that's very significant. That's our single largest cost item outside of the toll milling. So we're looking at both those two areas as the key focus and targeting a 20 to 25% cost reduction. That would make this a project that we could look at turning on. We would be looking at the Shakespeare project, which is much smaller than Wellgreen, as a potential cash flow generator to fund development at Wellgreen in lieu of equity financing down the road. Now we need to demonstrate through the studies that we're doing now over the next 2 or 3 months that it does make sense to turn it back on at these relatively low prices for nickel. But should that hold true based on our initial models, it looks like this could be significant in terms of the amounts of funding that we'll need to complete the engineering and exploration studies on the Wellgreen project over the next couple of years. Well, thank you very much. Rob and myself will be around for at least part of the afternoon if any of you would like to get together for any type of discussion in more detail. But thank you very much. We appreciate your time.